Forex trading, also known as foreign exchange trading, is the practice of buying and selling currencies on the foreign exchange market with the aim of making a profit. The foreign exchange market is a decentralized global market where currencies are traded. Let's say that you are planning a trip to Japan, and you need to exchange your US dollars, USD, for Japanese yen, JPY. The current exchange rate for USD JPY is 110.00, which means that $1 US is worth 110.00 Japanese yen. You go to a currency exchange booth or a bank and exchange 1,000 US dollars for Japanese yen. You will receive 110,000 Japanese yen. During your trip to Japan, you spend some of your Japanese yen on various expenses, such as food, transportation, and souvenirs. Let's say that you spend a total of 90,000 Japanese yen. At the end of your trip, you go back to the currency exchange booth or bank and exchange the remaining 20,000 Japanese yen back into US dollars. The exchange rate has changed since you first exchanged your money, and it is now 108.00. You will receive 185.19 US dollars. This means that you lost some money on the exchange, as the exchange rate decreased during your trip. Forex trading involves the simultaneous buying of one currency and selling of another. A currency pair is a combination of two different currencies that are traded against each other in the Forex market. In Forex trading, currency pairs are quoted as one currency relative to another currency, meaning when a trader buys a currency, they are selling the currency that they used to buy it, and vice versa. The value of a currency pair represents how much of the second currency is required to buy 1 unit of the first currency. For example, the Euro-USD currency pair represents the euro against the US dollar, USD. The value of the Euro-USD pair indicates how many US dollars are needed to buy 1 euro. If the current exchange rate for the Euro-USD pair is 1.2000, it means that 1 euro is worth 1.2000 US dollars. Let's say that a trader believes that the value of the euro is going to increase relative to the US dollar, USD. The current exchange rate for the Euro-USD pair is 1.2000, which means that 1 euro is worth 1.2000 US dollars. The trader decides to buy 10,000 euros, which means that they will sell 12,000 US dollars. The trader holds on to the euros for a period of time and then sells them when the exchange rate has increased to 1.2500. This means that 1 euro is now worth 1.2500 US dollars. The trader sells their 10,000 euros for 12,500 US dollars and makes a profit of 500 US dollars. This profit is the result of the increase in the value of the euro relative to the US dollar. With the currency pairs, we have two types: base currency and quote currency. Base currency is the first currency in a currency pair, and its value is always equal to 1 unit. The base currency is the currency that a trader is buying or selling when they enter a trade. Quote currency is the second currency in a currency pair, and is used to determine the value of the base currency. There are 3 main types of quote currencies. Major currencies. Major currencies are the most actively traded currencies in the Forex market and include the US dollar, USD, Euro, Japanese yen, JPY, British pound, GBP, Swiss franc, CHF, Canadian dollar, CAD, Australian dollar, AUD, and New Zealand dollar, NZD. These currencies are frequently used as the quote currency in currency pairs and are considered to be the most liquid. Minor currencies. Minor currencies, also known as cross currencies, are currency pairs that do not include the US dollar as either the base or quote currency. Some examples of minor currencies include the euro against the Canadian dollar, Euro CAD, or the Australian dollar against the Japanese yen, AUD JPY. Exotic currencies. Exotic currencies are currencies of emerging or developing countries, such as the Brazilian real, BRL, South African rand, ZAR, and Mexican peso, MXN. These currencies are considered to be less liquid and have wider bid-ask spreads, which can result in higher transaction costs for traders. Definition of long and short. A bullish market or trend is characterized by rising prices, increasing demand, It's a series of higher highs and lows. In a bullish market, buyers tend to outnumber sellers, leading to an overall increase in buying pressure and upward movement in prices. Long is same as bullish. A bearish market or trend is characterized by falling prices or decreasing demand. It's a series of lower highs and lows. In a bearish market, sellers tend to outnumber buyers, leading to an overall increase in selling pressure and downward movement in prices. Short is same as bearish. Let's move on to bid, ask, and spread. Bid refers to the price at which a buyer is willing to buy a particular currency pair. Ask refers to the price at which a seller is willing to sell a particular currency pair. For example, if the current bid-ask price for the Euro-USD currency pair is 1.2000-1.2005, it means that a trader can buy €1 for 1.2000 US dollars or sell €1 for 1.2005 US dollars. Spread is the difference between the bid and the ask. The spread is usually measured in pips. For example, if the bid price for the Euro-USD currency pair is 1.2000 and the ask price is 1.2002, the spread would be 2 pips. This means that if a trader buys the Euro-USD at the ask price of 1.2002 and immediately sells it back at the bid price of 1.2000, they would incur a loss of 2 pips. With that being said, let's get to know what a pip is. A pip, short for percentage and point, is the smallest unit of price movement in a currency pair. It represents the 4th decimal place in most currency pairs, except for pairs that involve the Japanese yen, where the 2nd decimal place is used. While a pipette is equal to 1/10 of a pip, which means it is 1/100th of the smallest price movement that can occur in a currency pair. It represents the 5th decimal place. Example: if the Euro-USD currency pair moves from 1.2000 to 1.2001, it has moved 1 pip. Similarly, if the USD-JPY currency pair moves from 110.00 to 110.01, it has also moved 1 pip. However, if it moves from 1.25001 to 1.25002, it has moved 1 pipette. A lot size refers to a standardized trading position size. A lot represents a specific amount of currency units. The 3 most common lot sizes used are standard lot. A standard lot is equivalent to 100,000 units of the base currency in a currency pair. For example, if a trader wants to buy 1 standard lot of the Euro-USD currency pair, they would be buying 100,000 euros. Mini lot. A mini lot is equivalent to 10,000 units of the base currency in a currency pair. For example, if a trader wants to buy 1 mini lot of the Euro-USD currency pair, they would be buying 10,000 euros. Micro lot. A micro lot is equivalent to 1,000 units of the base currency in a currency pair. For instance, if a trader wants to buy 1 micro lot of the Euro-USD currency pair, they would be buying 1,000 euros. Example: a trader wants to buy 1 standard lot of the USD-JPY currency pair at a current market price of 110.00. 1 standard lot of USD-JPY is equivalent to 100,000 USD, so the trader would need to invest $100,000 to open this position. If the market price of USD-JPY increases to 110.50, the trader would earn a profit of $500. On the other hand, if the market price of USD-JPY decreases to 109.50, the trader would incur a loss of $500. Leverage refers to the use of borrowed capital, in the form of a margin deposit, to increase the potential return on an investment. Leverage allows traders to control a larger amount of currency than they would be able to with their own funds. Example: a trader wants to open a position worth $50,000 in the GBP-USD currency pair, and their broker offers a leverage of $150. The trader would need to deposit $1,000, or 2% of the position size, as margin. The remaining $49,000 would be borrowed from the broker. If the trade moves in the trader's favor, and the price of GBP-USD increases by 100 pips, the trader would earn a profit of $500. 100 pips times $5 per pip equals $500. However, if the trade moves against the trader and the price of GBP USD decreases by 100 pips, the trader would lose $500, which is the same as their margin deposit. Margin refers to the amount of funds that a trader needs to deposit with their broker in order to open and maintain a trading position. The margin acts as a form of collateral or security against any potential losses that may occur while the position is open. Example: a trader wants to open a mini lot, 10,000 units, of the Euro-USD currency pair, and their broker requires a margin of 1%. The trader would need to deposit $100 or 1% of $10,000 as margin to open the position. If the trade moves in the trader's favor and the price of Euro-USD increases by 20 pips, the trader would earn a profit of $2. 20 pips times $0.10 per pip equals $2. However, if the trade moves against the trader and the price of Euro-USD decreases by 20 pips, the trader would lose $2, which is the same as their margin deposit. In the upcoming video, we will delve into the details of when to sell or buy, and we'll also explore additional relevant aspects of the topic.